Cryptocurrency is among the most rapidly expanding industries in history. Cryptocurrency has demonstrated its ability to attract entire new markets of investors seeking less restrictive laws and regulations than more traditional trade markets like the Nasdaq and S&P 500. Note that the SEC would strongly argue that existing restrictions do not apply. This allure has only become stronger as the value of cryptocurrencies such as Bitcoin and Ethereum has skyrocketed. Yet it is precisely this lack of clear regulation that makes cryptocurrencies excellent selections for financial scammers, particularly for lesser valued cryptocurrencies or altcoins. For example, when altcoin Squid debuted in October 2021, its value skyrocketed in a matter of days, reaching nearly $2,800 per coin. The coin's value had plunged by November. Squid's designers brought out all available tokens for a flat sum of $3 million, and all online profiles associated with the coin went black, prompting many early investors to dismiss the coin as a pump-and-dump scheme. It appeared that the coin, like the show after which it was named, only had one true winner. How does one spot and avoid these crypto pump-and-dump schemes? Are they legally overlooked? All these and more we'll take a deep look at in this video. Hey there and welcome to the channel. If you're new to the channel, subscribe and turn on notifications to receive notifications whenever a new video is released. And if you have any suggestions, don't forget to hit the like button and leave a remark in the comment field below. Cryptocurrency is a risky market with a high level of volatility. Many of its investors are aware of this, but some telltale indicators can alert investors to whether a new cryptocurrency or altcoin is nothing more than a pump-and-dump scheme for its investors. What is a pump-and-dump scam? Pump-and-dump schemes have been around for a long time. These strategies have been around for as long as there have been trading markets. Pump-and-dump schemes work when an individual or group of investors buy a large number of shares, or in this example, coin, of an asset or stock while the price is low, as per the Motley Fool. Following the acquisition, the person or group will begin producing and disseminating news about the asset in question, the majority of which will be false. This draws in more investors, causing the asset's stated value to rise or pump. When the asset's price rises to a level that the scam's creator can profit from, they sell their position to new investors. But because the originator owns the majority of the asset shares, the asset's price and worth begin to fall. You are correct if you think it seems like a fraud. After reading this explanation, pump-and-dump schemes are not only unethical but also illegal according to the Securities Act of 1933, which makes it illegal to obtain money or property using any false statement of a material fact or any omission to state a material fact. Regardless of the perceived lack of regulatory certainty surrounding cryptocurrencies, fraud is still fraud. Pump-and-dump scams continue to plague the Bitcoin industry and its investors regardless of their illegality. Minting new cryptocurrencies and altcoins is significantly faster than waiting for traditional fiat-based stocks to appreciate, and with hundreds of cryptocurrency exchanges available around the world, crypto markets are excellent targets for pump-and-dump schemes. Though it's not always simple to spot, several warning signals could alert investors to a potential fraudulent scam. Pump-and-dump features. Pump-and-dump is easy to spot. Price surges occur for no apparent cause and are not in line with the general cryptocurrency market trend. Long-term investors aren't interested in initiatives with a capitalization of tens of thousands of dollars. Hence, pumpers are more interested in these startups. Pump features include, without any meaningful underlying explanation, a sudden price spike and multiple ask orders. The quote rise on a specific platform while being unchanged or other exchanges. Advertisements and recommendations for buying cryptocurrencies in internet chat rooms, forums, and social media networks. It's critical to distinguish between a pump and a price surge caused by basic factors. Pumps are going for junk coins worth less than a cent, which isn't in CoinMarketCap's top 1,000. Pumping coins worth a few dollars is tough. Much more money would be required to have a major impact on the price. Any fundamental price increase that is founded on some reasoning, investors buy an asset, not for the sake of making a quick buck, but because they perceive the potential for growth and user advantages. During a pump, prices can increase by 300 to 500% or more in a matter of hours. Pump-and-dump schemes frequently experience growth of 1,000 to 3,000%. Fundamental price increases of 100 to 200% are uncommon. The coin price always reverses after a natural surge when it comes to pumps. However, it reverts to former levels. The token price declines only slightly during fundamental growth, allowing investors to profit. Dumps and pumps are temporary, lasting only a few hours or days. After core growth, there may be a period of correction. Recently organized pump and dump has grown in popularity. It is founded on the fact that everyone interested in participating in the project joins the community, where organizers communicate information about the approach pump while keeping the coin to be pumped a secret until the last minute. These type of activities are not common on large trading platforms. To begin with, they do not accept minor cryptocurrencies, and it is difficult to pump large ones. Second, they attempt to limit the use of comparable tactics. There are, however, certain exceptions. Bittrex and Yobit, for example, are two of the most popular pumping platforms. Are pump and dump schemes illegal? Pump and dump schemes are illegal, as we've established, but the question of whether the pump and dump model complies with the law is confusing for various reasons. How do you prove that investors are in cahoots? After all, a fundamental price increase caused by investor panic is not illegal. The manipulation, on the other hand, is. How does one determine who is on cahoots? On a well-established exchange market, it's simple, but on an anonymous cryptocurrency market, it's nearly impossible. Who and how should be held responsible? It is impossible to hold cryptocurrency pump participants accountable because they are nationals of many nations around the world. The pump organizers can and should be held liable in theory. However, they must be identified in some way. Pump and dump tactics are prohibited according to regulators because the price should be determined only by market forces, and any artificial manipulation is a deceit of investors. Regulators, on the other hand, admit that they lack strong legal grounds to prohibit such schemes in cryptocurrency. In several nations, the legal position of cryptocurrencies is still being resolved. Furthermore, authorities lack adequate means to persuade pump participants and prevent their occurrence. Regulators, on the other hand, are not given up. The Australian ASIC infiltrated one of the main closed pump channels in October-December 2021, but all they could do was shut down the channel and issue a warning to its users about possible penalties and legal action. How to spot and avoid pump and dump cryptocurrency scams. It's a lot simpler to recognize a pump and dump scam after you've already lost money to one than it is to spot one ahead of time. As a result, conducting research before investing in one is the first step to recognizing and avoiding one. If you notice a flurry of articles, headlines, or posts on the internet regarding a new cryptocurrency's rapid adoption, don't be the first to jump in. Instead, seek up the coin in question and read the white paper that accompanies it to learn more about its designers and their motivation for minting it. If there isn't a white paper, this could be your first indication that the coin is becoming a new pump and dump scheme. Likewise, if a coin's expansion has ceased even though it has been available for a longer period, this should alert investors to the possibility of a hoax. When an asset performs well but its creators and/or lead investors refuse to publicize it, a variety of red flags should be raised about its legitimacy. Furthermore, every cryptocurrency, like any other tradable asset, should have a particular purpose that its creators can demonstrate through a well-thought-out product plan. If that purpose isn't apparent, or if the roadmap has been stagnant for a long period with little or no revisions, this could be a red flag for a potential pump and dump scheme. So, what's the conclusion? The greatest method to avoid falling for a likely cryptocurrency pump and dump scheme is to observe how the coins trade over time. Similarly, the more well-known and established the exchange on which the coin trades, the less probable it is to be a pump and dump scheme. If the coin's price jumps at regular intervals or refuses to drop when it should, there's a good probability that Bitcoin con artists are behind its creation. Marketing and price management. Always conduct your investigation, and if something appears to be too good to be true, it most likely is. We'd like to know your experience with pump and dump schemes. Let us know in the comments section. If you enjoyed the video, give this video a thumbs up. Also, click the red subscribe button and turn on the notification bell icon so you can get notified next time we drop a new video. Thank you for watching. Bye-bye.